Good afternoon, everyone. Thank you for signing up. We have a very exciting webinar for you today, the 5 financial pitfalls to avoid in 2023. I'm Kurt, and I'm your presenter today. We're going to run through a few logistics so you know what to expect and there aren't any surprises. These slides are available upon request. My email address is in the chat. It'll also be on several of the slides coming up. Again, I'm Kurt Lalomia. For any late arrivals, I'm a financial advisor at Turning Point Financial. Here's a little bit about my background, my bio. I specialize with federal employees. You see the designation, Chartered Federal Employee Benefits Consultant. I've taken classes, I've taken continuing education, I've taken tests in order to be able to know your benefits really well. Turning Point Financial is what's known as an RIA, or Registered Investment Advisor. We're located in Frederick, Maryland. The SEC is our regulator. We're independent. We're a team of 25. We're fiduciaries. That means we're required by law to do what's in our client's best interests. That's me as an individual, and that's the firm overall. We get asked that question a lot. If you're looking for an advisor, make sure they're fiduciary, because not every advisor out there is a fiduciary and held to the fiduciary standard. One last thing, we work with clients around the country from most of the federal agencies. As I said, we're located in Frederick, Maryland. Next is our webinar calendar for 2023. Keep an eye out for these things. Here's what we're going to be doing today. This is the flow. This is an educational forum. I'm not here to sell you anything. I think I'll open your eyes to some things. I think you'll learn something new. We'll have Q&A at the end. Your participation today entitles you to a complimentary meeting with me if you're interested. I'll tell you how that works a little bit later on. Let's get into it. Our 5 pitfalls to avoid in 2023. They're in no particular order. Some may be obvious, some not. All are important. All need to be handled. Pitfall number 1, not having your beneficiaries in order. Living in this state, it's dangerous, and you can cause serious harm to your loved ones if you don't have beneficiaries assigned or your beneficiaries are not up to date. Beneficiaries are on your TSP. They're on your IRA, your life insurance. Some of you have TOD accounts. TOD stands for transfer on death. You want to review these beneficiary accounts every year, and changes can be made online in more and more places today. Your beneficiaries should be people. You want people, not your will, your trust, your estate. Sometimes, it's rare, but sometimes there are unique circumstances where naming an entity rather than a person is appropriate. It's not common and it should be avoided. One reason for this is efficiency of transferring assets. Your loved ones will receive your assets much faster, much more efficiently when you name them directly as beneficiaries. If you don't have beneficiaries assigned and something happens to you, a judge will be the one making decisions. This is not what you want, and certainly not what your loved ones need. It can take a long time and it costs money. Another thing, beneficiary accounts are different and operate separately and independent of your will. Let me say that again. Beneficiary accounts are separate and operate independent of your will. 2 different things. You can leave everything to your spouse or partner in your will, but it does not include these beneficiary accounts we're talking about. Let me tell you a story about a situation our client had. A husband's will had him leaving everything to his wife. The husband's IRA beneficiaries, they were his brothers and sisters. Guess what? The bulk of the assets were in the IRA, and that created a problem for his wife. Bring this up because coordination is important. Your estate attorney, your financial advisor, they need to be working together on your behalf to distribute the assets the way that you want. Hopefully your financial advisor is having these conversations with you. Moving along, our next pitfall to avoid in 2023 is not managing your asset allocation. Some of you wonder what I'm talking about. That's okay. That's why we're here. As I said, this is an educational forum. Let's start with your TSP. You're all familiar with the TSP. How many of you know the current allocation in your TSP? That's not only which funds you own in the TSP, but where your current contributions are going. How much is Roth? How much is traditional? These are questions you have to be able to answer. This is your diversification. It's how much risk you're taking. And it determines how large your TSP might become. Having too much in one fund may be under diversification, and owning too many funds, particularly multiple L funds, that's over diversification and likely holding you back. It's holding you back from earning more, holding you back from properly managing risk. Let me know. Let me know if anyone would like a complimentary TSP review or if you'd like to take our risk tolerance test. It's online, it's free. Let's take this a step further. Asset allocation, that refers to how much you have in the stock market, how much you have in the bond market, how much is uninvested in cash. There's real estate, there's commodities. That's something you all should know. We have that presented here on the slide. While your TSP is likely your largest financial asset, all your assets have to be considered when you're reviewing your overall asset allocation. This is combining all of your accounts. Accounts like the bank account, the IRAs, the TSP. Your spouse or partner might have a 401k, a 403b. There's brokerage accounts. There's 529s. You put all those together. What's the overall asset allocation? That will tell you how much risk you're taking or not taking. And that would lead to conversations we might have about being over diversified or under diversified. We're going to wrap up this slide with rebalancing, and that's how you manage risk. Some of you wonder what I'm talking about. We're going to stick with the TSP in our example. Maybe you're in one of the L funds. L stands for life cycle. If you're in an L fund, the rebalancing is done automatically for you. The L funds rebalance every quarter. They become more conservative as you age. That's the purpose of an L fund. That's why people own L funds. Let's take it further. Many of you don't have an L fund. So what do? Well, let's go back to where it began. Early on, you set an asset allocation in your TSP, maybe 50-50. 50% stock market, 50% bond market. That might look something like 50% in the C fund, 50% in the F fund. Over time, markets move. That allocation is going to change. Rebalancing helps to keep you at 50-50. If you need help with this, please let me know. It's important. Not doing it or neglecting it, that's going to lead to what we talked about earlier, over diversification or under diversification. Next is tax diversification. Not having a long-term tax strategy is a pitfall. Anyone with retirement money in traditional accounts needs a long-term tax solution. That's a traditional IRA, a traditional TSP. Higher taxes are coming our way. And when you get into your 70s and the government forces you to take money out in the form of RMDs, that's required minimum distributions, taxes are owed, and they're owed at whatever tax rate exists at that time. Having a tax diversification strategy can help you manage this looming storm. Optimizing your assets is how we manage it. And doing that leads to a tax efficient withdrawal strategy. I know this has some of your heads spinning right now, wondering what the heck I'm talking about. There are things you can do today, this year, next year, and beyond to lower that long-term tax bill. I'm talking about Roth contributions in your TSP, Roth IRA contributions, and Roth conversions. Whether you're preparing for retirement, approaching retirement, or in retirement, it's important that you understand the tax impact on your money. Roth and traditional accounts, along with taxable investment accounts, they give you tax diversification and the ability to execute different tax strategies. What does all this mean? How do we do it? You do this by engaging your team. And at its most basic level, your tax preparer or CPA and your financial advisor, they're communicating, they're coordinating, and putting this in place for you. So make sure the two of them are talking about your financial life. At Turning Point, my firm, we do all this under one roof. We're fortunate. And it's the primary reason we've grown our tax department so much. Coordinating with the other team members to optimize your assets in such a way that it minimizes your taxes over the long term, that's the ultimate goal. If you don't have this in your life, you should talk to someone about it. Last week, I was talking to one of my clients about what I saw in her Vanguard accounts. She had done a financial plan with us, but she was reluctant to move the assets because we're more expensive. I'm going to let you in on a little secret. Everyone's more expensive than Vanguard. Vanguard does a great job. They have a reputation of being the low-cost provider in the industry. And for some people, that's the right fit. Part of the low cost comes at the expense of service and advice. My client had large capital gains in her Vanguard accounts, and taxes are owed on these capital gains. She was surprised when I brought it up. She didn't know. Vanguard didn't advise her. The advice and recommendations that we offered in her financial plan, they wouldn't have allowed this to happen. She wouldn't have incurred these additional taxes related to capital gains. In other words, the Turning Point fee to manage her money would have easily paid for itself. While you may seemingly save money in an asset management fee, you may end up paying more, a lot more, if you're not paying attention to the 4 items that I've highlighted here on this slide. These 4 items make your portfolios more tax efficient. Sometimes people are saving nickels, but they're losing dimes because they don't grasp the bigger picture. Folks, taxes matter. And if you don't have your tax strategy integrated with your investment strategy, it's costing you. Our next pitfall to avoid in 2023 is not having enough Roth. Everyone here today should be making contributions to your Roth IRA, your Roth TSP, both if you can. Roths are funded with after-tax money. They grow tax-free, they come out tax-free. That's tax-free income, and that can have a major impact during your retirement years. Tax-free income in retirement, that can lower your Medicare premiums. That can lower the taxes you pay on Social Security. And Roths can reduce or eliminate RMDs, required minimum distributions. Maybe this is making more sense why we all need Roths in our lives. Roth participation, that's the quickest way to building your tax-free bucket for future tax-free income. It's a tax-free bucket. We got into this in great detail during last month's webinar. Maybe you were there. Tax-free bucket, that's your Roth balance, your Roth IRA balance, your Roth TSP. In financial planning, one of our goals is to help our clients make the tax-free bucket the largest among their allocation. Roth conversions, they allow you to take an old IRA, an old 401k or 403b, or even your TSP when you retire, and move those funds to a Roth. We're converting from traditional to Roth, or moving money. You pay taxes on the amount you convert, so we generally like it as a long-term tax strategy. We manage that conversion amount by studying the tax table, filling up your current tax bracket. And now is a phenomenal time to be involved with Roth conversions with the market down. Personally, I love the Roth. I have a Roth IRA. My wife has a Roth IRA. We make Roth 401k contributions. We also participate in Roth conversions. You can contribute to both Roth TSP and Roth IRA. The contribution limits, they were raised at the end of last year for 2023. Let's go over those. $22,500 can go into your TSP. That's the maximum contribution. If you're age 50 or older, you can participate in the spillover or catch up. That allows you to put in an additional $7,500. Roth IRA limits also raised, $6,500 if you're under age 50, $7,500 if you're over 50. The taxes on Roth and traditional, very different. I'm going to try to explain those through a story. It's my acorn and tree story. Maybe you've heard it before. As I'm going through the story, the question to keep in mind is, do you want to pay taxes on the acorn or do you want to pay taxes on the tree? The acorn is our contribution. The acorn grows into a tree. If we use $10,000 as an acorn contribution for the Roth and apply a 20% tax rate, because we funded the Roth with after-tax dollars, it cost us $2,000 to do that, or 20%. Over time, that $10,000 of contributions grows tax-free into a tree and becomes a hypothetical $100,000. We have a $100,000 tax-free bucket in the Roth. Traditional, a little different. We get the tax benefit up front. Our taxable income is lowered. That's nice. Our money grows tax deferred. So we put $10,000 into a traditional TSP contribution. That grows to a tree of, again, $100,000. We apply a 20% tax rate to that $100,000, and we have a tax obligation of $20,000. So taking a step back and summarizing, with the Roth, we paid $2,000 in taxes for a $100,000 tax-free bucket. With traditional, we got a tax benefit up front, but we owe $20,000 on our $100,000 tree. I'm not saying all of your money should go into the Roth. but everybody needs some Roth participation. Everybody's situation is a little different. I hope that story helps you better understand the differences between Roth and traditional. Our last financial pitfall to avoid in 2023 is not getting your financial plan done. The firm I work for, Turning Point Financial, we are a planning firm. It's our core business. It's how most people come to know us and work with us. It's my firm belief that everyone needs a financial plan. Doesn't matter how old you are, how much money you have, your stage in life, when you're going to retire, whatever. I know some of you already have one. Many of you, it's on the to-do list. A financial plan, it analyzes all the pieces of your financial puzzle. It helps you figure out the best way to accomplish your life's goals. I uncovered 3 facts about financial planning I want to share with you. They're not going to be on the slide, but I will definitely have them highlighted on a future presentation. 3 facts about financial planning. 1, it can cause your lifetime portfolio return to be higher than it otherwise would have been. You're getting professional advice. Financial planning can save you more in time, effort, worry, and record keeping. Planning gets you organized. And 3, financial planning can save you more in the cost of mistakes that you will avoid. Again, professional guidance and advice along the way are going to help you avoid the big mistake. Last week, I had a conversation with one of your colleagues on this topic, and they asked me the question, what does financial planning mean to you? And that sort of caused me to pause and reflect, and I came to realize that many people simply don't know what financial planning is. Again, that's okay, and that's why we have these educational forums. So I thought it would be helpful for me to share with you how we do financial planning at Turning Point Financial. Think of your plan like a visit to the doctor. Financial plan is a diagnosis. Just like your doctor asks a lot of questions to diagnose and understand what's going on, in financial planning, we ask our clients a lot of questions too. What are your goals? What are your dreams? What do you want to avoid? What keeps you up at night? We also ask you for all your financial documents. I'm referring to your Social Security statement, your pension statement, TSP, bank statements, pay stubs, mortgage and any other debts, insurance. We look over your auto insurance, your homeowner's insurance, and your life insurance. Investment accounts outside the TSP, tax returns. That's a lot of what we look at. We then take you through our 3-meeting process with our planning team. The team uses sophisticated software. That software analyzes all your stuff, and it provides a unique visual experience with colorful charts, graphs, and tables so you can better understand what your financial future might look like. These meetings, they're highly interactive, they're engaging, they're online, they're in person, they're just an hour. When we get to the end of the 3rd meeting, you get recommendations. If we were the doctor, the prescription would be the recommendation. Our recommendations, they're action items for your plan to be successful. There's a timeline. We email task reminders so you know what to do and when. And we then walk with you on into the future for accountability to ensure that your plan is successful. As I said, the plan is designed to solve your goals, and we want our clients to achieve their goals, their dreams, their lifetime wishes. A financial plan, it provides a roadmap to making it real. If you didn't know what a financial plan is, I hope this helps you to understand why we all need one. Because absent a plan, all you really have is a wish. One last comment. I didn't do my first plan until later in life. That was okay for me. Wish I'd done it sooner. For that reason, I admire my younger clients that do this in their 30s and 40s. Most people wait. There's really no good reason to do that. Acting now, it ensures that you'll have all your bases covered. Gives you time to fix potential problems. Certainly lowers taxes, and it'll give you clarity on your financial future and peace of mind. This slide is going to highlight our key takeaways through the 5 financial pitfalls to avoid in 2023. Again, these slides are available upon request. I appreciate you being here today. I'm going to have my email up on the next slide. As we wrap up, I want to thank everyone for your patience, for being here today. My full contact information on the screen. Please reach out if I can be of service. Consider me a resource, whether it's now or in the future. If you have a question, send me an email. Early on, I mentioned a complimentary meeting. Your participation today entitles you to a complimentary meeting with me. If that's something you're interested in, send me an email and we'll get a time scheduled. And we can talk about some of the things we covered here today or anything else that might be troubling you in your financial life. Thank you again for being here. Really appreciate your time, your interest. I hope you'll consider attending future webinars. We do these generally every month, every other month. I shared our webinar calendar with you early on. Thank you. Have a great afternoon. And I look forward to seeing you again.